Let's start off with Janet Yellen. Is this idea of a Goldilocks scenario still kind of playing out for you? Because I think you perhaps worried that it's running almost too hot for the Fed's comfort.
Well, the baseline, not the 100% scenario, the baseline is still, we've got enough strength in the labor market that the Fed and other central banks can probably engineer a softish landing. That means, we don't undershoot the target at the end of the cycle. But you're right, the risk is actually that there's still too much demand pressure in the economy. I would say real interest rates are not particularly high. Financial conditions are not particularly tight. So although the baseline is for a soft landing, the risk is that the Fed may actually have to do more.
What are the risks? I'm thinking primarily we've seen this huge run-up when it comes to the US dollar, and it's hard to see that those fundamentals of divergence will change, right? Does that create pressure in this part of the world?
Yeah, a strong dollar is very much the part of the story where the Fed stays higher for longer and U.S. growth outperforms the rest of the advanced economies. Right, if you've got dollar debt or you're worried about capital inflows or investors are looking at rate or growth differentials, and if you're a deficit country, yeah, that's a warning sign for you. Those countries would not prefer to have higher dollar for longer. They'd rather have a more moderate dollar path. But yeah, for certain economies in those buckets, that is a risk, yes.
How much are you worried about China? Because it doesn't feel like, our previous guest said, Beijing is willing to do whatever it takes. Are they, though?
Well, first of all, the surprise, again, has been the comfort around what apparently looks like a miss on the growth target. So I know the target's about 5. We're about to put out a new forecast. We're leaning lower. But I think this risk we've been worried about for quite a long time is starting to manifest, right? It's the structural, right? The overbuilding of the property, which feeds into confidence, which feeds into weak land sales, which feeds into weak local revenues. So the strategy so far seems to be to tweak it, and maybe the state banks lower rates and extend maturities, kind of the extend and pretend model. Is that going to be enough to right the ship, or do we need something more structural to get some sort of, asset management structure involved? For now, we'll have to wait and see. The Chinese have a good track record of being able to tweak the economy, as you know, and create growth. But for now, I'd say China's going to underperform on the growth front. And if you're exposed to Chinese demand, the Chinese consumer story really never picked up the way we thought. Again, those are the stress points for the U.S., maybe not so much, but this part of the world, absolutely.
Feel free, Paul, to give us that new forecast for China growth right now.
No, for compliance issues, but we're at 5.2 in the previous round, and let's just say we're leaning lower. We're going to be publishing in a couple of weeks. But Vani, that's the narrative is what I just told you. The expected burst coming out of the household sector post Party Congress last year kind of fizzled out, and now we've got stress in the property sector. So the question is the comfort level of the authorities for weaker growth, and then whether these kind of small, surgical moves are going to be enough to restore confidence, because again, it's that loop now between the health of the property developers and the local government revenue and the consumers and finishing the houses and the buildings and everything. That's all kind of interacting now and pushing down growth and confidence. So can we engineer a recovery with some tweaks, or do we need to do something more fundamental? That's the question to watch.